I'm Richard Pennell and welcome to the Mortgage Home channel. We are your buy-to-let mortgage and insurance experts. And in this video, I want to talk about how you would be eligible for lower rates if you apply for a portfolio mortgage. Now, straight away, you might go, oh, Rich, please explain what on earth is a portfolio mortgage. Before I do that, if you wouldn't mind doing me a really quick favor, if you haven't done already, would you please like and subscribe to the channel? It gives us that feedback that we're on the right track. We're giving you the right sort of content. We don't really get that feedback in any other way. Otherwise, we sort of playing it blind. So that would be really, really appreciated. Right. So let me get into portfolio mortgages and hopefully getting better, more preferential rates. What does that mean? So first of all, to describe this type of portfolio mortgage, usually when you submit an application, either yourself or via your broker, it's one property on one application, usually. But there are certain lenders that offer an incentive if you were to put two or more properties on one application for a specific type of product called a portfolio mortgage. Now, some of these lenders will allow you to put up to 30 properties on one application. Now, I know the reality of that is highly unlikely because it's unless you bought all these properties at the same time, then you're going to have fixed rates ending at various points throughout the year. So that's not going to be appropriate. But if you've got 2, 3, 4 properties coming towards the end of their deal at roughly the same time, then it is another consideration you should be making, or your broker should be picking up on to say, right, well, we now potentially have this portfolio product on the table as well as all the other usual individual ones. So yeah, you can have up to 30. That's the first thing. So why would we consider that? Well, there's a convenience factor. It's not the only thing. I've got some real biggies at the end, but let's start with the smaller benefits. It is one application, so it's a little bit more efficient if you're using a broker. From a broker point of view, you're only supplying the documents to that one lender at one time. So it's also therefore quicker because we've got one underwriter looking across the board at the 2, 3, 4, 5 properties at the same time. That also helps because you're going to get one consistent answer. If we've got 5 properties, 5 applications, 2 or 3 or 4 lenders with different rules, different policies, different underwriters, different views on your situation, how they interpret your financial position, well, now we've got down to one underwriter, one conversation. So if we can get that one underwriter to understand your quirky scenario or get something through, that means it will apply to all your properties and then therefore all the mortgages. We've got one direct debit. I don't know about you, but crikey, keeping tabs on all the direct debits that are going out of the bank statement. So now you just get one DD across those 2, 3, 4, 5 properties, whatever that is. As I said earlier, they incentivize you by giving you improved rates. So, great if the lender's going to give away a little bit more of their margin if you're prepared to put multiple properties and therefore multiple mortgages their way. Win-win. But here's the real reason you should be considering this. Now, the first one is around stress tests. You should all understand this phrase has been around, this bit of jargon now for, I reckon, 10 years. So the stressed affordability test, where they'll take your rent, put it through a formula and convert it to how much you can borrow. So have you got a property where the rent is considerably lower than it would normally be for the size of mortgage? It's a poor yielding rental property, but for whatever reason, you keep hold of it, you're not selling it, but it might be an issue of converting that rental to get the 75% borrowing. Well, here's the beauty of these types of portfolio mortgages, because what happens here is, let's say you put in 3 applications, you got 3 properties. One is this very shabbily producing rental, but the other 2 are really strong. What the underwriter does, he or she doesn't assess it each as an individual. They look at the aggregate figures. So they add together the 3 rents. and they do one assessment. And as long as on aggregate it passes the test, happy days. So essentially, your two stronger properties are grabbing the weaker one and pulling it over the line. And therefore, it will attract and get that preferential rate. So if you've got a weaker property in your portfolio, then that may well be a godsend for you, and get you off SVR and get you onto some better rates. The other real advantage is, do you have a property that's a high loan to value? So well in excess of 75%. We're not going to get into why that might be, but let's say you've got a property at 85%, 90% loan to value. And of course, lenders are not going to touch it as an individual property. You would get declined if you put an application in with an 85% loan to value. They're not out there right now. So you're going to really struggle unless you're going to prepared to put a lump sum in to bring the LTV back down towards that 75%. Well, here's an exception. Same thing. If we've got 3 properties and let's say the other 2 are lower loan to values and there's only one that's at 85%, but the others are at 60, 65%. The underwriter looks at the aggregate loan to value, not the individual. So as long as on aggregate it passes under 75%, happy days, box ticked, and on we go. So 2 fantastic reasons if you've got particular properties within the portfolio that are just poor from those 2 metrics point of view, either poor in terms of the stress test, poor in terms of LTV. If you're thinking, well, what lenders never take into account is capital growth. So you might be keeping hold of certain properties because it's fantastic for accumulating equity and the capital growth. And yes, the yield and the cash flow's poor, but maybe that's not a priority for you. But for a lender, you get penalised. So it's a couple of really good examples of why this type of product could be ideal if you have those 2 sort of challenges when it comes to refinancing. I hope this video has been of use to you today, and have a good day.